Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting. And our topic today is accounting changes. We have some accounting changes, and our topic today is changing accounting principle according to the USGAAP. So guys, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin. So let's start it. We have three types of accounting changes. Changing the accounting principle, this video. Accounting estimate, we have a video about that. And the video is in our video description. And in reporting entity, we also have a video about that. And it is in our video description. Okay? Uh, and what is changing accounting principle? Change from one generally accepted accounting principle to another. Adopt a new accounting standard, change method of inventory method from cost method to equity method, and so on. Estimate, revise and estimate depreciation, useful life, residual value, and so on. And change from reporting as one type of entity to another type of entity. And we are talking basically about consolidation here. Okay? So, accounting principles. Three approaches. And for all of our accounting changes and errors, by the way. Retrospective approach. Financial statements issued in previous years are revised to not only the current year. Modified retrospective approach. New standard apply only to the current year. Adjust retained earnings balance at beginning of year. And prospective approach. Effects of a change are reflected in the financial statement of only the current and future years. And we leave the past in the past. So, changing accounting principle, change from one generally accepted accounting principle to another. Though accounting choices once made should be consistently followed from year to year, changing circumstances might make a new method more appropriate. Examples are switch from FIFO to LIFO or vice versa. Most voluntary changes in accounting principles are reported retrospectively because they are voluntary. So we need to report it when we have it and also in the past. Here, let's go to our Excel file. Let's zoom it here. I have no idea why my camera is not here. So let's see if I can. Okay, whatever. So let's do it. Skyping Corporation used the LIFO inventory costing method. At the beginning of 2021, decided to change to FIFO. And here is our data. We are in 2021. This is our current year. Some gray here. And we have the retrospective years 2020, 2019, and previous years. Cost of goods sold according to LIFO, the one that we are using currently. Cost of goods sold according to FIFO, and the difference. And here, additional numbers, revenue, operating expenses, dividends, income tax rate, and the beginning balance of retained earnings in January 2019 and inventory in January 2019. So let's revise here. Income statement 2019, 2020, 2021 according to LIFO and FIFO. So how do we do that? I will be doing 2019 again, and then the other ones will be the same. Okay? Revenue 2019. Here, does it matter if we are talking about FIFO or LIFO? The revenue will be the same. Cost of goods sold, LIFO 600, FIFO 540. Gross profit, revenue less cost of goods sold for LIFO and FIFO. Operating expenses 320, FIFO and LIFO. operating income gross profit less operating expenses, income tax, operating income times the income tax rate, 25. Operating income times 25. And net income, operating income less income tax. The Yeah, very good. And here I am rounding our numbers, okay? Only to make it easier. Balance sheets, what do we have? We copy and paste these numbers here. Cost of goods sold and LIFO and FIFO. So here we have our difference. Cumulative difference, cost of goods sold and also inventory. 450 and how much the income taxes? Tax, only one tax. For this difference, because if we are here decreasing cost of goods sold, we are increasing our net income, we need to pay tax. So the income tax here, so let me do 2019 again. Cumulative difference, beginning balance plus 2019. Income tax, 510 times 25%. And net income and retained earnings, the difference between cost of goods sold and income tax. Okay? Later, statement of shareholders' equity. January 1st, 2019. So here, according to FIFO. So how do we do that? That is the tricky question. Retained earnings according to LIFO, 1,050 plus cumulative difference for net income and retained earnings. 2019 net income. Net income 2019 according to FIFO. Dividends. Dividends, we have it here, 60. And we do it for every year. Okay? What about journal entry? Do we need to go back, open our accounting, and do one journal entry for each year? No. For journal entry, we do it only once, on January 1st, 2021. So if we are taking January 1st, 2021, what do we do? Inventory. So inventory, the difference. So we grab 2020 numbers because our journal entry is on January 1st, 2021. How do we do that? Let's delete it here. Inventory. Cumulative difference in 2020, 576. Income tax payable. We need to pay income tax, 144. Retained earnings, the number to balance. Debit less credit. 432 must match with net income and retained earnings on 2020. A little bit hard, a lot of job here. So watch this video how many times you want. Okay? And disclosure note. We need to create a huge disclosure note here. Justify the application of the new method. No disclosure must explain why the change was needed. Comparative information has been revised and report any per share amounts affected for the current period and all prior periods, just like we did in our Excel file. Modified retrospective approach. FASB sometimes allows a modified retrospective approach. Apply the new standard only to the adoption period, the current period, and then adjust the balance of retained earnings at the beginning of the adoption period. So what do we do on modified approach? We do only the 2021 income statement. We don't need to show the new income statement or new balance sheet and so on. So we don't need that huge note. We only start on 2021 and we do our journal entry here on at the beginning of the year, of the changing year. So here, beginning of 2021. So we don't need to do all of this job here, presenting the new income statement, effects on balance sheet for previous years and so on. We only do the journal entry and we are good to go. Prospective approach, when retrospective application is impractical. Impractical to determine some period specific effects. Impractical to determine the cumulative effect of prior years. So we start doing it at the beginning in the earliest year practicable. We have no records of inventories on previous years, or we have it only in 2020. We don't have this cost of goods sold here for the previous years. So we start on 2020. Okay, so that is when retrospective application is impractical. Or the prospective approach when mandated by an authoritative accounting literature. So only when it's mandatory. If a new accounting standard update specifically requires prospective accounting. So that is not by choice, only when it's mandatory. Okay, for a change from the equity method to another method of accounting for long-term investments, GAAP requires the prospective application of the new method, for instance. Okay, so here only when it is required. When it is uh, uh, when it is voluntary, then we need to do the retrospective approach. Okay, guys, so thank you so much. Questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.